Fair value of gross assets acquired shall exclude three things. One is cash and cash equivalent, second thing is deferred tax assets, and goodwill resulting from the effects of deferred tax liabilities. These are the three things to be excluded while calculating the gross asset, fair value of gross assets acquired. Now, what are the reasons for these three? Next, cash and cash equivalent. So why excluded? To prevent entities increase the acquisition costs with no economic substance. Parent paying 100 rupees as purchase consideration, and while acquiring asset there is 20 rupees cash and cash equivalent. So ultimately net payment is how much? 80 rupees. 100 I pay, 20 I get back. It has no economic substance if we consider both. Paying 100, getting back 20. That's why this cash and cash equivalent are excluded. It has no economic substance. Second thing, deferred tax assets. Including this could lead to concentration test not being made. Deferred tax asset, what? If one deferred tax is recognized, that will increase the value of the gross assets acquired. That means it will be difficult to meet the concept. It has to be at least 90%. Third thing is goodwill resulting from the effects of deferred tax liabilities. Recognition of deferred tax liabilities would increase the initial carrying amount of goodwill. So value of the assets will go up. Deferred tax liability increases the value of the goodwill. Goodwill debit to deferred tax liability. So any goodwill arising from effects of deferred tax assets are to be excluded. Next, fair value of gross assets acquired. How do we calculate? It is normally the total obtained by adding the fair value of the consideration plus fair value of any non-controlling interest and the fair value of any previously held interest, if any, to the fair value of the liabilities assumed other than deferred tax liability, and then excluding the items mentioned earlier. That means cash and cash equivalent, deferred tax assets, and your deferred tax that liabilities, that is goodwill arising out of deferred tax liabilities. So first thing is, you see, three things are aggregated. One is the consideration paid, then the fair value of non-controlling interest, and fair value of any previously held interest at its present value. This is added to what? Fair value of liabilities assumed, but we ignore deferred tax liability. And from this figure, we exclude three things. That is your just mentioned cash and cash equivalent, deferred tax assets, and goodwill resulting from effects of deferred tax liabilities. Next, this example will make everything very, very clear. P Limited acquired 75% of AS for 1,200. Income tax, that is 30%. This is the balance sheet on the date of acquisition of AS. You see share capital 800, retained earnings 200, liabilities 400, deferred tax liabilities 100. Assets, land 200, building 50, equipment 400, cash and cash equivalent 350, deferred tax asset 50. Okay? The fair value assets are land 250, building 600, equipment 450. Now first thing what they say, fair value of consideration, we write down that they have paid, you see, 1,200 for 75% value. Then fair value of non-controlling interest. If 75% is 1,200, 25% is 400. So total is 1600. Then we need to add back what? Liabilities, but not deferred tax liabilities. Total is 2000. Then what are to be excluded? Cash and cash equivalent. You see here it is given 350. Next, deferred tax assets 50. You see it is 50. And lastly, goodwill arising out of deferred tax liabilities. How do you calculate? You see, fair value is more than the carrying amount. There will be deferred tax liability, and that will create goodwill. You see, first is land. It is 250 is the fair value, carrying amount 200. Building, fair value 600, carrying amount 500. Equipment, fair value 450, carrying amount 400. So, total amount is how much? 200. 50 plus 100 plus 50. 230% is 60. You see, goodwill arising from liability is 60. That is also excluded. Total is 450. So, this is the 1540 is the fair value of gross assets acquired is 1540. I repeat, purchase consideration paid, always at fair value. What is the fair value of non-controlling interest? Proportionate, 75% 1200, 25% is non-controlling interest, 1600. Then we add liabilities but not deferred tax liabilities, 2000, and we exclude three things: cash and cash equivalent given 350, deferred tax is given 50, and goodwill arising from deferred tax liability we have worked out earlier, it is 60 rupees, that we need to calculate separately. So amount excluded is 460. So 1540 is the fair value of gross assets acquired. One important thing that we need to see this, we ignore this deferred tax liabilities. We don't add back, but we exclude deferred tax arising out of goodwill. These are two things. It is existing deferred tax liability for S, and this is deferred tax arising out for business combination. Goodwill arises from deferred tax liability because difference in carrying amount and fair value at which the assets are taken over.